Okay. Hi, everyone, and welcome to today's webinar on reading and understanding Community Foundation financial statements and reports. This may not be what you would call a very interesting topic for many people, but we know how important the role of financial statements and understanding our finances as a community foundation is so important, and our work is so complex too. So I appreciate you setting aside the time today to join us. Next slide. Before we get started, I would just like to remind you folks that we have everyone staying muted for now, and we have a lot of content today. So rather than unmuting yourself, we would ask that you use the chat box to ask any questions to our presenter, and so we'll find time during that to answer the questions, and if we don't get enough time, then we will do some follow-up as well. We'll try and maybe take a 5-minute break in here somewhere. It's a 90-minute session, but as I said, lots of content, and so we'll keep pushing through. We are recording today's session, and we will share the slides and recording with you as well. And to remember to close all other applications on your computer so that you have the best experience and that your volume's at good control. Next slide. So my name is Cindy Lindsay, and I'm the Director of Learning and Network Engagement with Community Foundations of Canada, and I'm calling in from my home in Elora, Ontario. And I would like to acknowledge that I live on the traditional territory of the Attawandaron, Wyandot, Mississauga, and Haudenosaunee First Nations, so known as the people of Between the Lakes Treaty and the Haldeman Tract. And I'm pleased to co-host this session with my colleague, Tracy Vavrick. Tracy, I'll just turn it over to you to say hello.
Good morning, everyone, and thank you so much, Cindy. It's an absolute pleasure to welcome all of you to our session today. And I'm connecting to you from Grand Prairie, Alberta. I'm on Treaty 8 territory, pardon me, and on the traditional lands of the Métis, Kelly Lake Métis Settlement Society, and the Beaver First Nation. And I'm extremely grateful to work, live, and learn on the traditional territory of Treaty 8. And I am continuing to learn more on how I can be a better friend to our Indigenous communities, and as well to advocate for meaningful efforts in support of the return of the land to our Indigenous communities. Thank you again so much for joining us today. I'm going to turn it over to you again, Cindy. Thank you.
Okay, thanks, Tracy. And just a quick note to say that Tracy and I are both available to you as your colleagues in the Community Foundation Network to be available to answer any questions you may have in your work as community foundations. I know we have both board members and staff on this call, but also to introduce you to some resources and other learning opportunities. So please don't hesitate to reach out to either Tracy or myself. And now it's my pleasure to introduce Gordon Hawley. Gordon is the co-founder and president and CEO of Humanity Financial Management based out of West Vancouver. And Gordon has been a terrific ally for us. Not only has he been actively involved with the West Vancouver Community Foundation, but also sits on Community Foundations of Canada's Board of Directors as well. So Gordon, I will turn it over to you to say hello and to get things underway.
Wonderful. Thanks, Cindy. Well, good morning, everybody. Thank you for coming today. Just by way of background, I've been a chartered professional accountant for the better part of 30 years. I think I've got somewhere around 45 cumulative years of board experience, mostly as treasurer. I've been on the board of recently of the West Van Foundation for about 6 years. And I'm currently treasurer of Community Foundations of Canada. Started there about a little over a year ago. And so interestingly, I'll tell you that the topic today is a fascinating one. With our company, my wife and I run a small CPA firm, or about 20 people in Vancouver, and we work exclusively with charities, nonprofits, foundations, basically social purpose organizations, and our goal is to help them build capacity. So we work a lot with a lot of organizations in the social sector, with a number of foundations, and I'll tell you, out of all of the organizations we work with, community foundations are among the most complex and the most difficult to understand, frankly, even for CPAs. This is not an easy topic area. The finances of community foundations are extraordinarily complex. And so we hope today to give you some tools and some understanding of we're going to spend a fair bit of time on foundation financial statements, and then we're going to deal with some additional topics, but I'll get to the agenda in just a sec. So to the extent that there's any legal and tax information in the presentation today, it is information, it's not legal or tax advice. The views expressed are my own, and if you have any questions, certainly happy to answer them, but you may want to get independent legal and or tax advice. So for our agenda today, we're going to talk very briefly about the board financial governance roles and responsibilities and the primary financial risks that community foundations face. We're going to spend a fair bit of time going through external use financial statements. So these are the audited financial statements that most community foundations prepare every year, because we want to try and equip the people on the call with an understanding of how the choice of some very specific accounting policies can make a huge difference on your organization's financial statements. And in particular, if you've been on any other boards or if you've worked with any non-foundations or non-community foundations, the revenue recognition policy is significantly different. And so understanding the financial statements of community foundations is aided significantly by understanding, in particular, the revenue recognition method. So we'll get into that in a fair bit of detail. I'm going to actually go through a set of audited financial statements for community foundations and talk about the layouts and try and answer any questions people have. In addition to that, if we have time at the end, we'll also try and talk briefly about financial roles and responsibilities within community foundations, talk about some internal financial reporting, some of the key financial health and performance indicators that community foundations should at least be thinking about tracking on an ongoing and regular basis. And then we'll talk briefly about some T3010 or registered charity information return reporting. And certainly, if you have any questions as we go, please type them into the chat box, and periodically Tracy and Cindy will bring those to my attention, and I'll try and remember to ask for questions on a fairly regular basis. Okay, board's role in financial governance. Now, in terms of the primary risks facing community foundations, we think these are what I think the primary risks are. First of all, running out of unrestricted cash. It's great to have all kinds of big funds, but to the extent those funds are restricted and the use of the interest and revenue generated from the funds is restricted, you can't generally use it for operations. So one of the key metrics to keep an eye on is how much unrestricted funds you have as a community foundation, and we'll talk about that briefly later in the presentation. Occupational or employee fraud, theft, and embezzlement is a serious risk. It may not feel like it. You'd like to think we'd be able to trust everybody working in the nonprofit sector. There have been a number of studies done based on fraud in for-profit organizations and in nonprofit organizations, and the studies conclude that on average, 1 out of 4, or 25% of for-profit organizations have a significant instance of occupational theft, fraud, or embezzlement in the last 12 months. Every year, a quarter of for-profit organizations have this problem, and we think the numbers are significantly higher for the nonprofit sector, as much as twice as high. So, and many organizations don't know. They don't know that they have been hit, and so this is a real issue. It happens, and unless organizations have appropriate internal controls, it can be a real issue. Because if your foundation all of a sudden shows up on the front page of your local community newspaper because such and such a bookkeeper made off with $200,000, that's going to make it pretty tough to build back that reputational capital in the community. Accepting inappropriate gifts or giving out income tax receipts with errors or overvalued income tax receipts for gifts in kind is a risk. non-compliance with funder agreements. This is a really interesting one. We've worked with a number of community foundations that have gone back and looked at all their funding agreements and realized that it's very difficult to stay in compliance with all of the funding agreements. Some funding agreements require income to be allocated one way, and other funding agreements require income and capital to be allocated a different way. And what we find is that the community foundation generally has a way to do that, and it's neither of those ways, or it's one of those ways but not the other. So staying in compliance with the funding agreements is often a real challenge, and it's great to revisit those periodically. CRA payroll reassessment, if you have any staff hired as independent contractors, that's always a risk. Losing your charitable status. If you don't file your T3010 returns, or there's a number of other things that can lose you your charitable status. If you lose your charitable status, there's a 100% tax on all of your assets that you can either pay it to another charity or to the CRA, but literally it's 100% tax of all of the assets of the organization. So you don't want to lose your charitable status. And then there's some reputational risks, making sure that you've got appropriate internal policies and internal controls to protect the assets and make sure that the foundation is using them for appropriate uses. So there's risk to the organization, and there's also director personal risk. Directors can be held personally liable for up to 6 months of payroll, for payroll remittances, and for GST and HST remittances. So it's critical to, in my view, to maintain directors and officers insurance for the benefit of the directors, and also to for the directors to make sure that the organization staying up on its payroll remittances, its GST remittances, and all of its filing deadlines. In CFC, and I'll show this later, we have the first page of our finance report is a listing of all of our filing and remittance deadlines, and whether or not we're up to date, how much they are, when the last payment was made, when the next one's due, that kind of thing. So it's worthwhile for directors to pay attention to that on a regular basis and be reassured that the organization's staying on top of its regulatory requirements. We think there's 3 core capabilities that community foundations really need to have. The first is effective financial stewardship. Goes without saying, if you're not managing your finances well, it's going to be tough to attract donor funds. The same with investment stewardship. If you're not getting the kinds of returns that people expect, if they're giving you endowments or long-term restricted funds, they want to see some fairly significant investment returns. And effective governance. These 3 things, it seems to me, that most community foundations need to be kind of firing on all cylinders and maintaining these capabilities, making sure they've got, either CPAs on the board or people with significant financial expertise, people with significant investment expertise, and people with effective governance expertise. And if we do our job well as board members, in theory, donors will shower us with money. Our fund balances will grow, our grants will grow, we'll have more impact and more vibrant communities. So it really is, the board can have a significant impact on this. And so it's important for board members to take their job seriously and make sure that they're protecting the organization against the risks that we've talked about. Now, getting into reading and understanding, and I should have said community foundation financial statements. Let's talk briefly about audit requirements, just very briefly. There are 3 different levels of engagements that accountants can become involved with organizations with. One is a compilation report or a notice to reader. The other is a review engagement, and the third is an audit. The audit's the highest level of assurance, where the accounting firm does the most work. It adds the most credibility to your financial statements. So having an audit is, for a community foundation, usually pretty important. But interestingly, in BC, for example, there is no requirement by either the CRA or the BC Societies Act for organizations to have an audit. The requirements for an audit typically come from donors, from the bylaws, from internal governance policies, or somewhere else. Federally, there are requirements, and in other provinces there are requirements to have an audit depending on the size of your organization and the nature of its operations. So if you're incorporated in Ontario, you may have requirements to have an audit. If you're incorporated federally, you really need to check and make sure provincially whether or not you're required to have an audit. This is a typical audit opinion. Mostly you're looking for a paragraph that says, you know, in our opinion, these financial statements are prepared in accordance with accounting standards for nonprofit organizations, and it fairly reflect, you know, the finances of the organization. There are 4 types of audit opinions that you can have expressed with respect to your financial statements. The one that we all really want is an unqualified opinion. That says the financial statements are prepared in accordance with the accounting standards for nonprofit organizations. That's considered a clean opinion. And many accountants, by the way, when they're working with nonprofit organizations, particularly nonprofit organizations that deal with a lot of cash, they put on a qualified opinion. And a qualified opinion is close to a clean opinion, but there may be 1 or 2 issues, and usually it's around organizations that deal with high volumes of cash. If there aren't appropriate internal controls around cash, they'll put on a qualified opinion. We've seen a number of community foundations that have qualified opinions, but mostly that's a conversation to have with your auditor. It's possible to, if you don't deal with a lot of cash in particular, if you currently have a qualified opinion, it is possible to change the auditor's mind and to give you an unqualified opinion. There's also an adverse opinion, which says that the auditors don't believe that the financial statements accurately reflect the finances of the organization. And there's a disclaimer of opinion, which says we weren't able to do enough work or didn't get enough information to thoroughly conduct our audit, so we can't provide an opinion on financial statements. So obviously, we all hope to get unqualified opinions. And just so you know, in case you're doing researching and trying to understand more about the financial statements for your organization, it's very difficult to find information that is Canadian specific and not-for-profit organization or foundation specific. So there is relatively little information out there that's specific to community foundations specifically, and even specific to Canadian not-for-profit organizations. Now, here is one source that we recommend to virtually all board members. In fact, we encourage organizations to provide this source as part of their onboarding and orientation process. It's called a Guide to Financial Statements for Not-for-Profit Organizations. It's written by accountants, so take it with a grain of salt. It's not the most exciting book, but it is a free resource that you can download from the internet, and it goes into detail, even going so far as to say, you know, here's a typical statement of financial position. Here are the types of questions board members should be asking with respect to their statement of financial position. Here are the types of questions board members should be asking about the statement of operations. You know, and the same with respect to each of the statements. So it's actually a really useful guide for board members to better understand the auditor's role, the organization's role with respect to audited financial statements, and each of the statements for board members. So that's a great resource, I'll just point out. One of the reasons that community foundations financial statements are so complex is that internally, we're required to track the changes in individual fund balances. So we're not just dealing with the financial statements for the organization as a whole. We also, if we have, you know, 20 or 60 or 200 different funds, we're required to track each of those funds separately. And this is through something called fund accounting. And through fund accounting, we essentially prepare, and this is just an example of if we've got 2 different donor funds and an operating fund, we track the revenues, we track the investment income earned, we track any investment fees, any administrative allocations or fees, and any operating expenses. We need to make sure that we keep track of all of the transactions of the organization, of the community foundation, between all of the different funds. and then make sure that we're, again, in compliance with the funding agreements. So that adds a layer of complexity that most organizations don't have. Now, under the accounting rules, and this is key, the revenue recognition policy can have a significant impact on the way the financial statements look. And under accounting standards for not-for-profit organizations, there are two choices with respect to recognizing revenue. There's the deferral method and there's the restricted fund method. Most organizations use the deferral method. The last estimate I saw was about 70% of charities and nonprofits follow the deferral method. So if you've ever been on another board of another organization, or if you've ever worked in another organization, chances are they've followed the deferral method. Most foundations, including most community foundations, follow a different method. They follow the restricted fund method. And it's a choice. Any not-for-profit organization can decide whether it wants to use the deferral method or the restricted fund method, but the differences can be significant, and we'll go over that in just a minute. So this is straight out of the accounting guide from CPA Canada. If you're doing fund accounting, which most community foundations are, then if your objective is to show the activities, and this is where organizations like municipalities typically want to show activities, so they'll follow the deferral method. But if your objective is to show restrictions and show the different funds and what goes on within the different funds, then you use the restricted fund method. And so this is the method that most community foundations follow. And I'm going to briefly describe the deferral method just so you have something to compare it to. So as I mentioned, the deferral method is the most popular method. And there's two primary differences between the deferral method and the restricted fund method. With the deferral method, any surpluses on donor restricted funds are deferred to the balance sheet and recognized as revenue as expenses are incurred. And we'll go over an example of that in just a minute. So the way revenue is recognized means that there will essentially be no surpluses or deficits on restricted funds. So if you're looking at an operating statement using the deferral method, it'll likely mostly be either small surpluses or deficits. Very little change from year to year. There'll be small surpluses and deficits. Endowment funds aren't recognized as revenue. They don't even go through the operating statement. So if you receive an endowment of $10 million, it goes straight to the balance sheet. It doesn't show up as revenue on your statement of operations. Those two are significant differences with the restricted fund method. So let's see how it works. If I receive $1 million of restricted contribution, and this is if we're following the deferral method, and at the end of the fiscal year, I've spent $100,000, so I still have $900,000 of cash in the bank. We would show deferred contributions of $900,000 on the statement of financial position, and we would show the expenses, $100,000 that we spent. We would recognize $100,000 of the revenue essentially to offset the expenses, and we would show a nil surplus or deficit with respect to that restricted fund. So if I have 100 restricted funds, I'm always going to recognize just enough revenue to cover the expenses, and my surplus and deficit on restricted funds will be zero on any set of year-end audited financial statements. So as a board member in another organization, you would expect to see very small surpluses and deficits just related to unrestricted funds, and you'd never expect to see a big surplus generated, for example, by the receipt of an endowment. And I've included this just for your use. I won't go through it in detail, but this is a picture, again, out of the CPA handbook that shows how you recognize revenue following the deferral method. They're just for your information. So again, most community foundations follow the restricted fund method, and the two biggest differences are we basically record revenue as it's received. So if I receive, so we record revenue as it's received, even on restricted funds. So given the same example before, where we received $1 million restricted cash, and we've only spent $100,000 by year end, if we follow the restricted fund method, guess what? $1 million goes into revenue. It'll show $100,000 of expenses, and we'd be showing $900,000 surplus in that year. The next year, we might spend the remaining $900,000, we'd show zero revenue, we'd show $900,000 of expenses for that fund, and we'd show a $900,000 deficit. So following the restricted fund method, we can expect to have significantly higher surpluses and deficits from year to year, depending on, because basically we're recognizing revenue in the year that we receive it, regardless of when we spend it. The other major difference between the deferral method and the restricted fund method is that under the restricted method, endowments are recognized as revenue in the year that they're received. So if you receive a $100 million endowment, guess what? That goes through the income statement. It gets recognized as revenue the year it's received, and it gets recognized slowly as expenses over time as the organization. Well, basically, it never goes through as expenses because you can't spend the capital of endowment, right? So it basically just comes in as revenue, and you're only spending the investment income that is earned on that endowment each year. So here again, a picture showing that endowment contributions are recognized as revenue of the appropriate endowment fund. Restricted contributions basically get recognized as revenue in the year that they're received, and unrestricted contributions get recognized as revenue as well. So I should just pause there for a second to ask if anybody has any questions with respect to the difference between the deferral method and the restricted fund method. And Tracy and Cindy, I can't see the chat.
No questions yet, so I think we'll continue, but folks, feel free to put any questions you may have into the chat box. Oh, here's
Wonderful.
one. What is the reason for community foundations using the restricted fund method?
I think because it is easier for donors to understand, because if the donor provides a grant, they want to see it show up as revenue. And because again, we want to try and show in our financial statements, not so much the activities we're doing, which a municipality might do, but we really want to try and show what the restrictions on the various funds are. And so the way, and I'll go over the examples shortly. You'll see from the examples how restricted fund method financial statements look different. We typically actually have summarized funds in different columns on the financial statements, which you don't typically have in an organization that uses deferred revenue, deferred contributions. If you're using the deferral approach, you typically just have one column for the current year's results and one column for the previous year's results. Where we're showing the different funds or groups of funds, we actually have multiple columns. So we'll have a column for, endowment funds, and a column for restricted funds, and a column for unrestricted funds, and a column for, capital funds. So there's, it's a whole different set of the financial statements look significantly different. And in order to show those, the transactions in the funds and to make them easily understandable, that people can track what's happening with the funds, that's why most foundations and certainly most community foundations choose to follow the restricted fund method. And also to make it comparable to other community foundations and other foundations as well.
Great, thank you.
Okay, so a typical set of audited financial statements for a community foundation is going to have be made up of 5 or 6 components. First, there's going to be the audit opinion. Next, there'll be a statement of financial position or a balance sheet for a for-profit organization, a statement of operations or activities, a statement of changes in net assets or fund balances, and a statement of cash flows. And then there's the notes to the financial statements, which are an integral part of and should be read in respect of all of the statements. Now, a couple of points to make, and believe it or not, I've had this question before. Does the organization's financial statements have to have all of the operations of the organization, and yes, audited financial statements are required to encompass all of the organization's activities. We organize the general ledger accounts into asset and liability classifications. So current assets, fixed assets, current and long-term liabilities, etc. A statement of financial position has three sections. The first is assets, the second is liabilities, and the third is net assets or fund balances. And the statement of financial position focuses on liquidity. So in each of those sections, the closer to cash a particular item is, the higher up on the higher up within each section it goes. So cash is always the very first item. Bank indebtedness or overdrafts are always the highest liability, and then the longer term liabilities like mortgages or the longer term assets like fixed assets or property, plant, and equipment are toward the bottom. So it's structured there's a focus on liquidity so that the items that are closest to cash are at the top and the items that are furthest from cash are at the bottom. So the asset section is generally everything that an organization owns. So that's going to be things like money, cash and term deposits, accounts receivable, prepaid expenses. It's anything or property that the organization has purchased. Certainly there'll be investments for community foundations. Liabilities are everything that an organization owes. So that's current liabilities, which is payments that have to be made within a year, deferred contributions if there are any, which for most community foundations there won't be, and long-term liabilities, any debt or mortgages or anything like that. And then net assets is equal to the difference between assets and liabilities. And it's essentially your accumulated surpluses since the inception of the organization. So having a significant net asset balance can be an important indicator of financial health and sustainability. Okay, so just a few examples. I want to talk briefly about net assets. Again, this is a part of the community foundation financial statements that many directors and staff members struggle with. Net assets, and they're sometimes referred to as fund balances. There's a bunch of different names, and we'll give examples of that in just a minute, are in theory required to be shown in three categories. The first is endowment funds, which are endowments. These are restricted by external donors that are permanently restricted capital. Restricted funds, which again are restricted by external donors, and then unrestricted funds. And unrestricted funds can be completely, if somebody donates $1 million with no restrictions, you can use it for operations, you can use it for building capacity, you can use it for whatever you want. That would show up as an unrestricted fund. Unrestricted funds also includes any internally restricted operating reserves. So if the board decides to say, look, we've got this surplus, we're going to internally restrict $1 million of it to build a new office next year, that's fine, the board can do that, but it'll show up as a subcategory of unrestricted funds, not as restricted funds. Restricted funds and endowments need to be restricted by the donor, by an external third party. So endowments, we call these permanently restricted, although if there is and this is typically where the assets must be kept in, the capital must be kept in perpetuity, but you can use the investment income to support whatever causes were important to the donor. In theory, these are permanently restricted, but we've actually seen some scenarios where if there's an amendment clause in the fund agreement, they can change. They can be, the organization can call it an endowment today and change the agreement if it's allowed by the agreement and take all the money out and use it for current operations. That's probably not going to, that may not be in accordance with the funder agreement, but legally it can be possible. restricted funds. So these are often, these are things like donor restricted funds or donor advised funds, where the donors or donor designated funds, where the donor says, I want both the capital, maybe spent over 10 years, and I want the income used for these purposes. Anytime there's any kind of restrictions, it shows up under restricted funds. Unrestricted funds, we talked about this. This includes internally restricted funds or board designated funds where the board can change the designation. So if the board in 1 year decides they want to internally restrict some funds, for example, the next year the board could change that. So they're always shown under the unrestricted funds category if they're internally restricted by the board. Okay, so now we're going to get into an example of a set of financial statements that follow the restricted fund method. Now, one of the points I always like to make about the financial statements and the format of the financial statements is that so long as the financial statements are in accordance with accounting standards for nonprofit organizations, organizations have a lot of flexibility around the different categories they want to use to track how they want the statements to look. If you go and download, 191 sets of financial statements for community foundations, you'll find that there will be a significant variation on the format of the financial statements, how they look, how many columns are on each of the financial statements, what categories they use to track revenues and expenses. And it all depends on the story that you want to tell using your financial statements. And this is where organizations have a significant amount more flexibility than they often think. There really is a lot of flexibility at the West Van Foundation. We changed the format of our operating statement a couple of years ago. We thought it provided better information to funders and external users of the financial statements. So you can use the financial statements to tell your story. You can change the formatting of the financial statements to better suit your organization. The format that you use today may be different than the format you were using 10 years ago when the organization was smaller. So know that it's not just the auditors that have control over the format of your financial statements. If you see other examples in community foundation financial statements where you like the presentation better, don't hesitate to have that discussion with your auditor and adjust the format of your financial statements to better tell your story as an organization. So here's a set of statements, and I'm using one from the Vancouver Foundation just as an example. They follow the restricted fund method, and you'll see this is their statement of financial position. And you'll see that it has 3 columns for each year. There's, anyway, I think I've got the next slide has some more detail. So in the first set of 3 columns, these are for the year ended December 31, 2017. And they show 2 columns in a total. The first column is all of their restricted funds, and the second column is their unrestricted funds, and then a total. And they do the same for the previous year. The top section here is the assets of the organization, which includes all of the investments. The next section is the liability section, and this is the amount that the organization owes to others. And then the bottom section, I referred to it as net assets, but some organizations use the terminology fund balances. And you'll see that they've decided to group their funds into contributed principal, retained returns from investments, and investment in capital assets. And we talked about those being restricted and unrestricted. So if you're looking at a statement of financial position, you want to look for liquidity. Do the organization's current assets exceed its current liabilities? And the reason that's important is because if they didn't, the organization might run out of short-term cash. You want to look at solvency, the ability to pay the long-term debts of the organization if the organization has long-term debt. And you want to look for accountability and transparency. Do the statements provide enough information for people to interpret them well? But a big focus for community foundation financial statements is the unrestricted cash and unrestricted net assets. So hopefully your statements show those and allow people to see that. And you also look for significant changes in trends. So here's just a few examples from a few sets of financial statements in terms of how different community foundations show their net asset categories. As I mentioned, they're the three that are in theory specified by the accountants that break it down into endowment funds, restricted funds, and unrestricted funds in example 1. In example 2, there's restricted funds, discretionary funds, and operating funds. Example 3, community and field of interest funds, donor advised and designated funds, and flow-through funds. Flow-through funds is terminology I probably wouldn't use anymore, but there are still some community foundations following that. And then the fourth example is operating funds, endowment funds, grant stabilization funds, and restricted long-term debt. So, and this is just 4 examples. You know, if you took 191 community foundations and looked at their financial statements, you'd probably see 60, 70, 80 different sets of terminology. So it's important to think about as a board and as an organization, what story do you want to tell? What kind of terminology do you want to use? How do you want to group your funds on the financial statements to tell the story that you want to current and prospective donors? Same thing with respect to fund categories, different examples. So there is, community foundations actually have a lot of control over the terminology used in their statements and the format of their financial statements.
Gord, there's a question about the terminology around flow-through funds. You know, in terms of what term should we use instead of flow-through, or why wouldn't we use the flow-through fund terminology?
Yeah, great question. There is some risk with the Canada Revenue Agency that they might interpret the terminology of flow-through funds as the community foundation managing some funds on behalf of another organization. And that's typically not allowed except under very limited circumstances as a registered charity and foundation. So we've seen, I think the terminology we're using today at the Westband Foundation is spend down funds. So these are funds that eventually will be entirely spent. And we received legal advice from our lawyer, from our charities lawyer, not to use the terminology flow through, because there was some fear that the CRA might interpret that in a way that they think we were doing something not allowed by the charities regulations. And the other types of funds that are that organizations should be aware of pose some risk. There's a terminology called managed funds, and managed funds. The CFC hired a law firm, I think it was Miller Thompson, earlier this year or last year, to give their advice on whether or not community foundations should be accepting managed funds. And the general gist was that generally, community foundation, there's some risk involved if you accept managed funds because they're not entirely in compliance with securities and charity regulation. So if you do have managed funds on your statement of financial position, you should try and find a copy of that opinion from Miller Thompson. It's worth reading because they do represent, managed funds do represent some risk to community foundations, primarily from securities regulators.
Yes, and just to clarify, I mean, Scott, thanks for your question about having managed funds, the same as your explanation of flow-through funds, and not technically, because managed funds are not assets of the community foundation, so that they are still owned by a charity other than the community foundation, and it's just being pooled with us for investment purposes, but we don't own those assets in comparison to flow-through or spend down funds, which are owned by the community foundation. So there is that fundamental difference, and we will share that resource that you mentioned, Gord, to everyone.
Sounds great. Thanks, Cindy. Yeah, there's some really interesting questions that come up around the idea of managed funds. We've seen some foundations, and you go back and look at the gift agreement, and what we've found is that some organizations actually accept cash and accept donations, but the agreements, the way they're worded, are actually more like trust agreements, where the original organization, and so it can either be a trust where the community foundation's managing essentially as a trustee the assets, or it can be managed funds where the community foundations agreed to just manage the funds on behalf of another organization. But you're right, Cindy, the general gist of that is that for the most part, when people give funds to community foundations, they give a gift. And that's the way the agreements are set up, that it's a gift to the community foundation owns the funds. But under these other agreements, and this is where the risk is, if the funding agreement is worded either as a trust or managed funds, there can be risks with both of those. So good to look into if you have either of those on your balance sheet. And worth going over your fund agreements periodically to make sure that you're in compliance with your funding agreements. So here is the statement of operations for the Vancouver Foundation, again, for the year ended December 31, 2017. Let's see. So the three sources of community foundation surpluses and deficits. You can have an operating surplus and deficit. You can have investment returns, including realized and unrealized capital gains and losses. And you can have donor contributions, which is usually new money, net of withdrawals and grants, are typically the three sources of community foundation revenue and surpluses and deficits. So again, the Vancouver Foundation has its column set up as restricted, unrestricted, and total for each of the 2 years. At the top is the revenues section, which shows the contributions and the charitable activities and the management and administration. And then here's the revenue up at the very top. There's the expenses and management fees. And then we come up with excess or deficiency of revenues over expenses. And the bottom part of the statement there, Yeah, so in this case, they've actually got a combined, they've got the fund balances at the beginning of the year below the red box there, the interfund transfers, and the fund balances at the end of the year as well. So this is really a combined statement of operations and fund balances. But then the organization also has a statement of changes in fund balances where they break it out in a little more detail. And this is the detail that shows up on their statement of financial position, where they have the fund balances at the beginning of the year, the excess of revenue over expenditures, the investment in capital assets, transfers, recapitalized income, and fund balances at the end of the year. So this is essentially a continuity statement that shows the changes in fund balances from year to year. So if you're looking at your statement of financial position and you look down in the third section, in the bottom section, which is the fund balances, if you look at the balances at the end of the previous year and the balances at the end of the current year, this is the statement that shows you what changed from the end of last year to the end of this year. So this statement is like a continuity schedule for each of the fund balances. Oh, looks like these two slides were out of order. That is the fund balances part of the statement of operations. And by the way, this is another piece that's optional. You can have a separate statement of operations and a separate statement of changes in fund balances, or you can group those two together. Interestingly, the Vancouver Foundation has chosen to do both because I imagine they think it provides more complete disclosure. So they've opted to include a little bit of a continuity schedule on the statement of operations for the fund balances, and they've opted to have a separate statement of changes in fund balances as well.
Gordon, we do have another question that's come up too as well. Questions around accepting of funds. So looking at, are you recommending we don't take programs like ECSF and spend down funds? Can you expand just a little bit more on that one, please?
Yeah, no, ECFF and spend down funds are totally acceptable. We just need to make sure that we name them appropriately in our financial statements and make sure that we reduce the risk of either securities legislators or the charities regulators taking an issue with the way we're managing our funds. There, as a registered charity and as a foundation, there are rules that we're required to abide by. And we want to make sure that our financial statements reflect accurately how we're dealing with those funds and how we're representing them on our financial statement. So spend down funds are absolutely fine. There's some complexities around what they call flow through funds, because registered charities aren't allowed to, I won't get into the detail there, but there's some risk that flow through funds could cause some issues with the charities regulators. So we just generally the advice we received is that a better terminology is spend down funds will have less risk at causing problems with the charities regulators. Mm-hmm. And certainly something to check with your own legal counsel.
Yeah. Yes, because I think, you know, the terminology around flow through funds is sometimes aligned with flow through shares, and that's where we get into some challenges. But I think we will provide some clarity in the new year around when you are looking to complete your T3010 and where the ECFF money lands on your T3010. I think it's important that we have some good consistency about that, not only just the granting dollars, but also then the honorarium too.
Great, thanks, Cindy. So the statement of operations, usually, you know, the focus is the bottom line, the surplus or deficit. It focuses on revenues and expenses, and in some cases, continuity for fund balances. And as directors and others, we should be looking for primarily for changes and trends from previous years. So this is the statement of changes in fund balances again. You'll see that there's three different categories here. This is different than what showed up on in the two columns on the statement of financial position and the statement of operations, but it is consistent with the way the net assets are grouped on the statement of financial position. Again, this is one organization's format. And again, if you look at, 191 community foundations, you probably find 60 or 70 different formats. There's quite a bit of flexibility in setting up statements and organizing the statements to best tell the story for your community foundation. So it's worth having a look at periodically whether or not your current financial statements allow you to tell the story about your foundation. Then there's a statement of cash flows. I'm going to go fairly quickly through this, just because this one in particular, frankly, causes accountants grief, and accountants often struggle with trying to interpret it. So I'll just let you know that there's a couple of different methods you can use. There's a direct method and an indirect method. The accountants suggest that everybody use one method, and oddly, everybody uses the other, so it's a bit strange. The notes to financial statements are a critically important part of the statements, and it's absolutely worth reading. There are often more pages of notes to financial statements than there are financial statements, but the notes provide additional detail. And in fact, when I look at a set of financial statements, I look at two things immediately for nonprofit organizations and charities. I go to the audit opinion to see whether it's a clean opinion, and then I go to the notes to find out which revenue recognition policy they're following. So those are the first two things I look at, because if I don't know what revenue recognition policy they're following, I don't know how to interpret the financial statements. So the notes to financial statements can be critically important. Okay, does anybody have any questions before we move on to the other topics for today with respect to the financial statements?
Nothing at this point, Gord.
Wonderful. Okay, financial roles and responsibilities. So let's talk about the financial responsibilities of the board as a whole. First of all, the board as a whole has a number of responsibilities. The first is to make sure that it's receiving all of the financial information it needs to ensure effective financial governance for the organization. The board is also responsible for making sure that there are appropriately skilled people, including the treasurer and bookkeepers, controllers, CFOs, and appropriately designed financial systems are in place to make sure that the board is getting accurate and complete financial information. Ultimately, this is a board responsibility. You can't rely on management for this. We've seen organizations get in trouble where, you know, management hires a kitchen table bookkeeper to do the bookkeeping, and the financial reports that the board gets during the year are significantly wrong. If board members don't think that the people managing the finances of the organization have the right skills and capabilities, they need to do something about it. Boards need to identify financial risks and figure out effective ways to manage them. The board has to ensure that board members have the financial management skills and understanding to properly evaluate the financial reports that they receive. So building board literacy around understanding financial statements and understanding financial reports is critically important. And that the organization's in compliance with its regulatory environment. As I mentioned, it's a good practice to have at least one page of your financial report dedicated to all of the regulatory criteria and whether or not you're currently in compliance. The primary role of individual directors is to read and understand all of the financial statements and financial reports. And that may sound simple, but it's really all about asking questions until you as an individual board member understand the responses and understand the financial report. So on the face of it, it's fairly simple, but it's really all about asking questions and continuing to ask questions until you understand the financial statements and reports. And then satisfying yourself that the strategic plan is the most effective way to achieve the mission, that the budget's the most effective way to spend the available funds, and that the organization has enough resources to achieve its mission, is financially healthy and on budget, has enough insurance and financial reserves to protect itself, is effectively managing its financial risks, and is on side with the Canada Revenue Agency, securities regulators, and other regulators. And just to note, this is, you know, we've seen organizations where individual board members can look at themselves and go, you know what, I don't really have a financial understanding. I'm just going to let the treasurer deal with this. And to the extent that organizations get sued, that's not an appropriate defense for a director. All directors need to understand the financial statements and ask enough questions until they actually understand all of the financial reports. You can't leave that on other people's shoulders. It's up to each individual board member to make sure that they're comfortable with the financial statements. The typical roles and so the typical roles and responsibilities we see in organizations are broken down between volunteer positions and typically paid positions. The paid positions inside an organization are typically at 3 levels. There's sort of the compliance level, which is where you've got typically a bookkeeper. Then there's typically a management position or a controller level position. And these are the people that are typically CPAs that are primarily responsible for the accuracy and completeness of the financial information, for making sure that the financial reports are accurate that the board's getting. The controller will usually prepare the budget and cash flow projections if required, and come up with the cost allocation methodology. All charities and foundations are required to allocate all of their expenses on the T3010 between charitable activities, management and overhead, and fundraising, and I think there's a fourth, I think advocacy work. And what's interesting about community foundations, if you look at the way the expenses are allocated, is they're often significantly different for every community foundation. And what you want to make sure is that you're on the T3010 that your allocation of funds is consistent from year to year, at least your methodology, the cost allocation methodology. And then at the top level, you've typically got a CFO who's tasked with improving the financial health and performance of the organization, managing financial risk and financial sustainability, and capacity building and growth for the organization. So now, not all community foundations are going to be able to have full-time people in these roles. Some of these roles may be fulfilled by the executive directors in some of the smaller organizations, but somebody needs to take responsibility for these roles. And that can be board members in a very small foundation. It can be the CEO or senior staff in smaller community foundations. And then once you get up to the larger organizations, they do have full-time or multiple full-time people in each of these roles. But regardless of the size of the foundation, you still need to have all these roles still need to get performed. You just need to determine whether or not the people performing these roles have the skills and capabilities to do a good job. And it may make sense to hire a part-time controller or a part-time CFO, typically CPAs, to make sure that you're getting good quality financial statements and to make sure that from a financial perspective, the organization's being strategically well run. Now, let's talk about the treasurer. So we just talked about the paid positions, and we've talked about the volunteer board. We've talked about the paid positions inside a finance department. Now we're talking about the volunteer treasurer position. Now, I actually went through this process. I looked through both the Societies Act legislation for a number of different provinces and the federal Nonprofit Corporations Act, and I looked to a number of sets of bylaws. And for the most part, this is the description, this is sort of the common description of what a treasurer is supposed to do. Preparing an annual financial budget, managing the organization's financial transactions, keeping accounting records in respect of an organization's financial transactions, preparing the organization's financial statements and reports, and making the organization's filings with respect to taxes. You'll notice that this would be a position I would expect in a completely operating board of a very small organization. So this is a very small organization without any staff. This is what I would expect the role of the treasurer to be. And in fact, I suspect if you go look at your either your local Societies Act or your bylaws, you may find very similar description of what the treasurer's role is. Now, I would make the argument that for the most part, the treasurer's role is to make sure that these things happen, not to actually do them themselves. If you've got the treasurer doing all this work, they're functioning really they're doing the work of what should be a paid employee, and they'll likely burn out, they likely won't stick around for very long, and you'll likely have turnover in your treasurer role. But it is important for the treasurer to make sure that these roles are being done on a regular basis. The other pieces that I would add to a description of a treasurer in an organization of any size would be to advise the board about financial issues. And this is why hopefully we've got a CPA in the treasurer role or somebody with significant financial expertise. That the treasurer should be the most knowledgeable financial person in the organization because they're often tasked either by default or intentionally with ensuring that all of those previous roles are getting done, but also providing the board with strategic financial advice about how to run an effective community foundation. Treasurers also help reduce financial risk and increase efficiency and effectiveness of financial systems. Help develop the financial literacy of board members. So first of all, by answering all their questions and providing input on the financial reports that are provided to the board. A good treasurer would also bring in additional help if they think they need it, i.e. if you've just got a bookkeeper and you don't have anybody in the CFO and controllership role, by indicating the need for bringing in those additional roles. and an ideal treasurer would also help to find and train a successor for if and when they leave the organization. So does anybody have any questions about financial roles and responsibilities in community foundations before we move on to the next topic?
Hi, Gord. I don't see any questions quite yet. So
Wonderful.
Perfect.
Okay, there should be some time for questions at the end as well. So
wonderful. Just one comment here is there's a lot of information to absorb and really appreciate. Oh, we do have one question, sorry, that's just come up. And should the treasurer be a CPA? What's your recommendations on that?
Yeah, in an ideal world, yes. Well, let me rephrase that. They can either be a CPA or somebody with some significant financial expertise. So this can be somebody with a banking and finance background. I think community foundations are complex enough that you really want to have somebody with a solid financial background that can help analyze and interpret your financial statements, can give you advice with respect to the formatting of your financial statements, can review the skills of your internal people to determine whether or not they've got the right skills to be providing accurate and complete financial reporting, can be, reviewing your financial systems to make sure that you've got the right systems in place. So having somebody that really has some depth in financial skill can go a long way toward reducing risk for not only the organization, but also for other board members. So yes, I think having a CPA or somebody with significant financial expertise helps reduce risk and helps other board members sleep better at night, knowing that there's somebody with a significant financial background, at least keeping an eye on the financial operations of the organization.
Gord, thank you so much for that. And just to add to that, Cindy and I are in the process of just updating some new fact sheets that will also include different roles, so the roles of the board members, etc. And so we'll have those materials be ready probably within the next few weeks. So it's a really good piece of what you've indicated here too as well around the competency and the capacity and the knowledge and skill. So we'll be able to provide those informations to this group as well.
Wonderful. Thanks, Tracy. Okay, let's talk briefly about internal financial reporting. So these aren't, once a year we prepare audited financial statements for the purposes of external audience, our donors, the CRA and others. But through the year, either on a monthly or quarterly basis, we're going to receive regular reporting from our finance department. There are sort of 3 or 4 areas that we want to keep an eye on with respect to finances for our internal reporting. The first is the financial health of the organization, which is really today. How are we doing today? What's showing on our internal statement of financial position? Do we have enough unrestricted funds to fund our operation going forward for the next few years? The financial performance, which is about the past. So this is usually the budget compared to actual. And we'll get into that in just a minute. Financial sustainability for the future. Are we setting up our foundation to be sustainable, to have the right revenue sources, and to be financially sustainable in the future? And have we been through a risk identification and management process where we've identified the primary financial risks and have put internal controls in place to appropriately manage those risks? So so now we're looking at essentially key performance indicators. Generally speaking, with respect to financial health, we're going to look at the statement of financial position, as I mentioned. So where are we at today? There's going to be key performance indicators that talk about liquidity or our ability to pay short-term liabilities. There are some key performance indicators that address solvency or our ability to pay long-term liabilities. And then there's the net assets. Do we have any strategic reserves to sustain operations, to replace capital assets, and to fund special projects? And if necessary, do we have regular cash flow projections that let us know if there's going to be any shortfall of cash in the foreseeable future? With respect to financial performance, we're usually going to hope to get a a budget forecast, so an annual budget, hopefully approved by the board before the beginning of the fiscal year. We're going to get regular either monthly or quarterly budget versus actual reports. And again, some of these financial performance, key performance indicators, which we'll talk about in just a minute, along with some operational key performance indicators. So it's not just the finances. We should also be looking at some operational key performance indicators in terms of what we want to track, what we want to manage and track as a community foundation. And then, as I mentioned, there's the cost allocation policy and methodology with respect to how do we allocate our overhead costs, for example, to different funds and within the categories for the T3010. This is just an example of the table of contents for our quarterly financial report for Community Foundations of Canada. The first page that shows compliance, this is regulatory compliance. When was the last payroll remittance due? When was it paid? When's the next one due? And all the regulatory, WorkSafe BC, GST, public service body rebates, all of the different regulatory pieces, we get that as part of our report. We then go into the statement of financial position, the statement of operations. We get into some notes to explain some of the things in the financial statements. There's a dashboard report with graphs and charts that focus on sort of 5 or 6 key performance indicators so we can see them in context, and then our investment results. So that's a typical report, a typical financial report for CFC. For some of the smaller organizations, that's probably overkill, but for a mid-sized community foundation or a large community foundation, that would probably be a pretty good outline of what board directors should expect. Okay, key financial health and performance indicators. Here are the sort of 6 things that I would be keeping an eye on for if I were on the boards of most community foundations. The first and foremost is the unrestricted fund balance. So, and the more the better. And I would encourage community foundations to consider how they might maximize the amount of unrestricted funds that they have control over. We're starting to see foundations now throughout North America actively go to donors and suggest to donors that the best way to support their organization is to provide unrestricted funds. First of all, because community foundations are, through our vital signs reports, we're likely closest to the action. We know what's going on in our communities, and we can likely put the funds to best use most easily if the funds are unrestricted. It also allows us to invest in our capacity building as an organization so that we can have more impact on our communities. So unrestricted funds, the total balance; unrestricted funds, the balance as a percentage of all funds. So that's on the capital side. Then there's unrestricted income as a percentage of all income. That's another metric I would want to track. Grant expenditures versus operating expenditures, I think, is useful to track over time to give the board a sense of how much of what we're spending is on operating expenses versus going out in grants. The operating expense ratio, so operating expenses as a percentage of assets under management, and the personnel cost ratio, so again, as a percentage of assets under management. Now, these are 6 that I've chosen. We track all of these at the West Van Foundation where I'm at, but there are others that other organizations think are important. It's worth having a robust conversation at the board to figure out which key performance indicators the board wants to track on an ongoing basis. Because often many organizations just get budget compared to actual and some explanation. But having specific key performance indicators that you're using to track the financial health and the financial sustainability of the organization go a long way, as I say, I think, to allowing board members to sleep better at night and really highlighting these sort of 4 or 5 or 6 areas that are critically important to the long-term success of the community foundation. Does anybody have any questions with respect to the financial health and key performance metrics?
Yeah, there's a question here, Gord. Are there benchmarks for these performance metrics, or is that set by each organization?
Yeah, great question. Great question. So the Canada Revenue Agency provides access to all of the information that's on the T3010 report is available to the public just by going up to their website. So you can literally benchmark, and all of these key performance indicators here should either be available on the financial statements or on the T3010. So you should literally be, any community foundation across the country should be able to benchmark itself against other community foundations. All of that information is publicly available. And these particular metrics aren't subject to allocation issues. So that's one of the problems with the T3010 information, is that it's very difficult to compare, for example, the overhead and admin on the T3010, because it's subjective and every community foundation calculates it differently. So these particular indicators I've got up here, though, aren't subject to allocation. They should be able to be pulled directly from the numbers should be able to be pulled directly from either the financial statements or the T3010. They're not subject to allocation issues, so they should be very effective for benchmarking. So as a community foundation, you can figure out which community foundations you want to benchmark yourself against. Presumably other community foundations around the same size or slightly larger, and do the benchmarking yourself, or you can get the assistance of your treasurer or your auditor. But yes, all of this information is publicly available and available to use.
Wonderful, thanks, Gord. It looks like that's the last of the questions there. Thank you.
Wonderful. And our final topic today is some issues to watch with respect to the T3010. Now, some of these are very basic, but oddly important. Here's a list of the T3010 common mistakes, and these are taken directly from the CRA's website. The return is mailed to an address other than the Charities Directorate. Make sure that when you're filing your return, it's going to the right place. The return's filed on the wrong form. Now, this is an important one. If you're preparing your own T3010, the CRA is very specific about which version of the form you use based on your year end. So if your year end is December of this year, you use this version of the form. If it's March, you use this year. You need to make sure you're using the right version of the form. You need to attach financial statements to your return. The T3010 report is not considered complete without a complete set of financial statements. And by the way, those financial statements can be requested by anybody. Any Canadian resident can call the CRA and ask for a copy of your financial statements, and the CRA will mail or email out a copy of those financial statements to the requesting individual. So that's just important to know. The financial statements do not have the same fiscal period as the T3010. That's oddly a frequent problem for the CRA. Fundraising activities instead of charitable activities are described in section C2. There's no entry on line 5,000 for charitable program activities. In theory, organizations are only, charitable organizations like foundations are required to have charitable operations. And if you don't put a number on the line for 5,000, that says to the CRA, you don't think any of your operations are charitable. Math errors and internal inconsistencies. There are quite a few places where you need to make sure that the math is right. And by the way, if it's wrong, the CRA will often post it anyway, but it doesn't look very good for your donors if they're going through the return and notice math errors. There's one section on the T3010, and I mentioned this earlier. After you list all of your revenues and all of your expenses, it gets down to the bottom and says, okay, now show us how all of your expenses are allocated between charitable activities, management and administration, and fundraising. And this is a critical piece that organizations often get wrong. And you want to make sure as a board member that you have a methodology in place to allocate all of your expenses between those 3 or 4 categories, and to make sure that you follow the allocation methodology consistently from year to year. Otherwise, again, if your numbers flip-flop by huge amounts every year, that's going to look really bad for your donors, to anybody looking up your T3010 at the CRA website. Some people fill out lines 5500 to 5520, and those are only supposed to be filled out if you've been granted permission to accumulate funds, i.e. that you're not subject to the disbursement quota. Now, this is a big one for community foundations, and I would venture to guess that probably half or more community foundations get this wrong. There's some regulations around the disbursement quota. Every charity and foundation is required to pay out between its expenses and its grants or its charitable activities 3.5% of its assets not used in charitable activities. Now, in community foundations, that means investments. Believe it or not, the CRA categorizes investments as amounts not being used in charitable activities. And so every community foundation should be calculating a disbursement quota and making sure that they're paying out every year the appropriate amounts. For many community foundations, lines 5900 and 5910 are not being filled out. So the CRA doesn't actually have the information, to determine whether or not the organization is acting in accordance with the disbursement quota. If you don't fill out 5900 and 5910, nobody has the information to determine whether or not you're abiding by the disbursement quota rules. So that's a really important piece, and a piece that I suspect many community foundations are offside on. The rest of the items here are mostly about filling out the director and trustee information. Often there's information missing. Having the qualified donee business number and registration numbers are often missing. And for many returns, the certification area on Section H isn't signed. So those are some things to look for as you're reviewing the T3010. In theory, all boards should review the T3010 before it's filed every year. So we're getting close to time here. First, I'll ask the question, does anybody have any questions with respect to the T3010? And then we'll open it up to any other general questions anybody has with respect to reading and understanding financial statements and the topics we've covered today. So, does anybody have any questions with respect to the T3010?
Thanks, Gord. I'll just mention that I think we'll probably do early next year a specific T3010 webinar, partly because 2020 has been a year of interesting challenges. We know some community foundations applied for CERB and were successful. We have the ECSF money coming through. We've had some taking on some charitable programs and activities as a way of working with non-qualified donees. And so there's a lot of things that I think would be really helpful for our community foundations to kind of walk through where these things sit within the T3010 and how we account for them. So stay tuned for that. That'll be early next year. If you think that would be helpful, Gord, we can work on that.
Yeah, no, that sounds like a great idea. There's a bunch of new things, as you say, Cindy, that came up this year that many community foundations won't have dealt with before. So many people may have questions about how to deal with those on their T3010.
Right. And so, yes, we have recorded this webinar and it will be available. Just give us a couple of days to get it processed, and we'll share the link to this one and to the one that we held a couple of weeks ago as well. And they will be posted. And if you do have any other questions, now's the time to ask. And while you're typing your question, I will share our upcoming events that we have. Next week on the 22nd is one on corporate philanthropy and community foundations. This is in partnership with our colleagues at Green Shield Canada that have created a corporate philanthropy toolkit. And then November, I think, is Finance Month and Investment Month here. We're working with some of our partners emerging from the pandemic and investment management from a board perspective. The ESGs and linking your investments to the Sustainable Development Goals. And then on November 25th, exploring trust-based philanthropy. So lots coming up in the next few weeks. Check out our events page and to register for those. And I know Tracy has done a great job in sharing so many of the resources that we referenced as well. And so that we can have that at your fingertips, and also to check out some of the resources in our resource library as well. Here is one quick question. Just received filing reminder. Is it the responsibility of the auditor to file it on our behalf?
That's a question between you and your auditor. Some auditors are tasked with filing the T. Sorry, is this for the T3010, Cindy?
Yeah. Yes.
Yeah. So some auditors, it's included in the discussions, and the auditor agrees to file the T3010. But unless the auditor is given specific direction to prepare and file the T3010, it's incumbent upon the organization to make sure that it gets completed and filed. Now, if the auditor is completing and filing the return, they still require that it be signed by an authorized signatory of the organization, and that should hopefully never happen without having the board review the T3010 and authorize the auditing firm to file it. So the audit firm can prepare it on your behalf. There's usually a charge associated with that, you know, $1,000 or $2,000, $3,000, depending on the size of the organization. But for many organizations, auditors prepare them because they can be complex. For smaller organizations that want to complete it themselves, that's fine too, but it's really based on the agreement between the community foundation and the auditor.
Great, thanks, Gord. If there aren't any other questions, I know we threw a lot of information at you today. The slide deck will also be available to you. You'll be receiving a follow-up evaluation and with these resources and links to it in the next couple of days. But thank you so much for your time and for your questions. If you have any other questions, please feel free to reach out to Tracy and myself, and I know Gord is also happy to field questions as well. So we'll leave it at that, folks, if there aren't any other questions. Gord, once again, thank you so much for your time. Really appreciate your support of the network and our work as community foundations. And folks, stay safe and stay healthy. As we see cases increase across the country, we hope that you and your loved ones are healthy and safe. And we'll look forward to seeing you on another upcoming webinars. Thanks very much. And thanks again, Gord.
Thanks a lot, everybody. You're very welcome, Cindy. Take care.